Hello and welcome to another episode of the Swing Trader Status Update. It's the second Tuesday, so that means we're coming back to you for our monthly webcast now. We're glad to be back, and joining me as he always does is Mike Webster, our senior market strategist and the brains behind Swing Trader right now. So, Mike, let's get right into it. We've got April 8th, 2025. Last time we were on, I mean, sure, there were some tariff, fears, but man, last week, a little bit brutal.
Yeah, it's been a mess out there, right? I mean, this is what a bear market looks like, and what kind of it was. I would classify what we've seen as a crash.
Yeah.
Frankly.
So
So
I just to kind of let you know, I'm looking at the YouTube comments, and again, it's great to see everyone again. Just asking, of course, who is one of our regulars. He's saying, "Man, I'm sleeping, I'm fishing. It's nice to kind of just relax sometimes, right?" And that's basically, we have been in cash, but I think it's important to note that you haven't been relaxing. Now, look, I was on vacation. Full disclosure, I was in DC and I wasn't trading. I wasn't doing anything. But you and Dominic, I mean, you were at it that entire time. You're screening all the time. There just isn't much to find.
Well, screening nonstop, and that's what you want to do in bear markets, because it gives you a feel for where the money is flowing, how weak is the market, is it strong in certain areas, or and you put all these little pieces together that you notice by screening. Like if you just go to sleep and you go on vacation forever, you're going to lose touch with the market. There's nothing wrong with going on like you went to DC with your family, and Nicholas had a great time, and I'm very happy for that, because it recharges the batteries. But you just don't want to be gone for too long, because you do lose a feel for the market. And so now we've been screening, and we wanted to put things on, but the risk reward was just out of whack. It was like, this is where you can get chopped to pieces. And I saw it in 2000 to 2002, where all of us, we got out in March of 2000. But then along the way during that bear market, we would go in, and we'd go in too heavy, and you would get all these paper cuts that would add up to what could be some serious damage. So we've been around the block. We both of us, or the whole team, has been around the block. And so we want to make sure that we're passing that experience on to everyone else who's following along with Swing Trader. And this is not the time to play hero. And so we haven't been. So we've been actively sitting out on purpose. And it's
Right, exactly. And not everyone realizes how hard it is for you sometimes to sit on your hands. When you say active, like sometimes you probably have, I don't know, do you use like shock therapy? What do you do? Like,
I do use shock therapy. I use my little shock thing here right now as well. It's
yeah, okay,
technically
perfect.
for
Yeah,
my
so
shoulder, but if I really want to place a trade, I can juice that thing up pretty high.
just attach it to your keyboard and like, oh, okay. So, no, that makes sense. And when you say we've been around the block, one of the things we're going to get to is not only are we going to go through some historical. Well, yeah, I mean, you're older, but it's a combination of studying history, and we're going to get into a little bit of that with some precedent analysis, and even just not that long ago with COVID. We're going to get into that a little bit with a COVID crash, because one of the best things about that is if you can be in cash and get kind of the outperformance, it really takes some pressure off when the market does turn. And you and I were both bullish optimists that eventually this market will turn. And when it does, there's a lot of false starts a lot of times. And so if you can be in a position where you don't have that pressure to necessarily have to go in on every single one, and or at least not go in deeply. And so we'll talk a little bit about that strategy as we discuss the overall strategy. But let's talk a little bit right now about this downtrend. I mean, certainly, as you stated before numerous times, the trouble really started on December 18th. And again, regardless of the reason, the chart is what really kind of sticks out as something changed there.
Yeah, it changed in a big way, and yeah, we don't have to rehash why, but that was the Fed day, and when Powell kind of not kind of, but shifted his stance, and the market picked up on that, and it hasn't been the same since. So that was a shot across the bow, and then we had some good days in there. There was, things were looking constructive. A lot of stocks were looking good, and it was really confusing, as because we were talking about it a bit earlier today. It was like, wow, well, this normally leads to really bad things, but lots of things look good. And with this whole AI thing, how is that not going to play out? And maybe the news just needs to be digested. Then on the
And
right there.
even after the DeepSeek news, that was right here on January 27th, which you would think that would have really led to bad stuff happening, but we were almost at highs, back above 20,000 in pretty short order.
Well, that was really healthy, actually, being
Mm-hmm.
frank. Like, we know what's happened now, but you always have to put yourself back in the shoes there. Like, so we lost the leadership because that was the AI and the DeepSeek. If people don't remember, because all the news has been out, but that is when, over in China, they basically figured out a much cheaper way of doing things. So that had implications for all the AI players, from Nvidia all the way down to all the utility related plays, in a big way. And so we lost that leadership on that day, but then the rest of the market lifted up. So we really could have been off to the races at that point, and just that group was going to sit out. But as we got near new highs, it failed. And once we crossed the 50-day, that was bad. But when we crossed underneath the 200-day, like the 200-day is the biggest deal in the world to me. Like, everyone knows that I follow and use the 21-day exponential. I lean super heavily on that for any tactical stuff. But as far as how is the weather outside, it's, are you above your 200-day or not? When you're underneath the 200-day, you have to question everything. You have to be very cautious, because when you're underneath there, it's you're in a bearish type of market. It doesn't always lead to a bear market, but well, back there on August 5th, it bounced off the 200-day, so that was very telling. And frankly, I didn't handle that move the way, in hindsight, that I wish I had. So, all this experience, you're like, okay, I messed up on that day, got to adjust the next time it happened.
But I
So
will still say, for again, you got to put yourself back in the time that you were at, knowing that this yen carry trade was disintegrating. That could have gone a lot worse. It didn't, but you really had to be prepared for that getting a lot worse. In the same way that, as many people might have been saying, oh, well, gosh, here we are, getting support at the 200-day moving average line. When that was happening in February, a lot of people could have been saying, well, look, this is getting support at the 200-day line. What's there to worry about? It can get worse, and it did. And even with this rally here, it rolled over, and we saw another leg down, and the second leg down arguably worse than the first.
yeah, well, when we were getting support at the 200-day initially, and it looked really good. That first upside reversal off the 200-day looked classic and picture perfect, frankly. But then the next day we had an outside day expectation breaker. That From that moment, if you could just point to that expectation breaker, like that was kind of the game changer for the tone of the market. Then we came down further, and then we had that follow through day. Yeah, right there. We had the follow through day. You could either call it a follow through day or a follow through day in spirit. The reason that why the spirit is there is because the volume wasn't higher than the prior day, um, which was a big deal for Bill O'Neill, the founder of IBD. But he would also use his judgment for things, and we saw it where he would change things on when it was around a holiday or anytime where the volume was going to be skewed differently. So, like a post Thanksgiving or on the Columbus Day, at times when the bond market was closed. So our market, the stock market, would have naturally less volume. He would make exceptions, and this one was a post triple witching. So you have an artificially high day on triple witching, just like when the Russell rebalances and you get this huge spike, or the S&P rebalances, you use your judgment in your brain and you're like, okay, there's no way to go further than that volume unless there's some really weird news. So what we would always do is look at what it was running, tracking at intraday versus the same time at the prior day. And all day on that follow through day in Spirit, it was tracking higher on NASDAQ than it was the day before. It was just that last little 5 minutes or so where the volume spike because of triple witching skewed things. So that was a follow
Which
through.
it typically, that's the way it kind of goes, right?
It always goes. Yeah. So so with the that follow through day, it was a legitimate follow through day. You act on that. You always act on a follow through day, and then you use the low of the follow through day as your exit, and that's what we did. And then we had like midday the next day, it looked like an upside reversal. So we tried some stuff, and then immediately, what we try to do with SwingTrader is not do any buys or sells in the last 15 or 20 minutes if we can at all help it, because we know that some people aren't going to be able to get their trade done. But late in that day, we would have wanted to back away when it wasn't holding. But so we exited the next morning, and then we haven't put on a trade since, and on purpose, because we failed the 21 day, our follow through day failed, and we were looking for a legitimate upside reversal where the risk reward made sense, and we haven't had one yet. And while
So
we're
what about a day like today, this day right here? I mean, we were discussing, I mean, it was an upside reversal. It did get some follow-up, but we also had this news event that was known. Everyone knew April 2nd, what President Trump was calling Liberation Day was coming. It was telegraphed. It was known. What wasn't known was the reaction that the market was going to do. It wasn't quite known what he was going to say, and we certainly didn't know what the reaction was going to be. So how do you handle that when you see an upside reversal, but you've got kind of that news event coming?
So we decided to sit on our hands, which was very difficult. It was really hard for me, because I knew that if we didn't buy on that upside reversal, we were going to have to skip the next couple days. And that's what we did. And so we were taking on, actually, frankly, a ton of risk of underperforming the market by not buying on that upside reversal. But we were really in a weak position in front of a big news event. And the other thing is, we're swing trading. We're not position trading. With position trading, you can have a stop of a maximum of 7%. But with swing trading, you really like your max around 3%, sometimes a little bit more if it's a high ATR stock or if it just frankly gets away from you. But in general, 3% is kind of your max that you want to go with. And going into a risk event, knowing what a big deal these tariffs were, that we didn't want to be caught in what would have been even worse, is put on some positions and then just getting shaken out midday because we're following our discipline. If you've got your swing trader hat on, you've got to follow that discipline. You can't let it go beyond your thing just because whatever you feel like it that day. So you follow your discipline. And so we sat on our hands, but it was hard, man. There was a lot of stress going into that event. And I know I'm probably the only person out there. I'm very hopeful that, let's put it this way. I see a path that this resolves itself in a very positive way. And you could see how quickly things changed yesterday morning when there was some fake news out there around the tariffs, and how quickly everything lifted. Like, the market wants to go higher. It just needs the information, because these tariffs are a big deal as they stand right now. Yeah, that was in a blink of an eye, and things were just, the indexes weren't even telling the whole picture. I mean, there were some things that were just flying off their lows, like really in a big way.
Palantir was up like 10% or something like that. And to, a point that you kept on making throughout the day was, even when the rumor was dispelled and the White House came and said, look, there is not a 90-day pause here, fake news. The fact that, yes, it came down off its highs, but the fact that it stayed above its lows was pretty remarkable, that it just kind of went sideways after that.
It didn't seem normal nor natural. Like it's like you have this spike up on this fake news, and then when it came out, like I really thought we should have gone back down and undercut yesterday's low. So it told you there was a lot of stuff happening yesterday, and it felt like a capitulation type bottom, but just we weren't ready yet. Now, today we start off strong and then rolled, and we really couldn't get, materially above yesterday's high on most things. This one just looks like it just touched above it, but it didn't really get above yesterday's high. So that was telling you that we were still in a weak position, because everyone just doesn't know what to do with their spreadsheets, because Wall Street is really run off of spreadsheets. Like, we like to look at charts, but the big guys and girls, they do everything off of valuations, and they need to put in their little spreadsheet of, okay, what is the risk-free rate of return? What are interest rates? And then what are certain very key items? And from an economic standpoint, from the fundamentals, like, that's a big unknown, because we don't know, are these tariffs going to get worse or go away or just stay where they're at? So we did get a lot of information so far. So we found out where the high watermark was for the tariffs if other countries don't go into a little battle. And so we're seeing with China right now. And I think once we have some more information on China and it is set wherever it is, once these levels are set and the market feels like, okay, President Trump is done negotiating and all the other countries are, and this is where the tariffs are going to be, the market will adjust to it. It just needs to put those values in there. It doesn't, now it might mean that we're at a much lower level, but then at least we'll get into an environment that we can trade. Like, it could be 10% lower from here, and then at that point we'll get a trend. We are trend followers, whether it's a short-term trend or an intermediate or long-term trend. We're trend followers. Right now the trend is down, and with this product, is not a shorting product, so we're sitting in cash because that's what our tools and our discipline say. But once this gets resolved, and I think it can get resolved a lot faster than most people think, but that's just one potential outcome. There's an outcome that it goes back and forth and this drags on, and
prolonged.
we could turn into a 73, 74 type of bear market, which would be horrible. That's in the cards. It really is in the cards. So with that, what do? You trust your instruments. You wait for a follow through day, which we could get in a couple days, because today was day 2, tomorrow's day 3. As long as we hold above yesterday's low, if on Thursday we're up 1%, it is a follow through day. And we would have to, we'll take some action. Now, one thing that we did want to let everybody know, that in this position, because the odds are really stacked against us, if you see us put things on SwingTrader, most likely, subject to change, but the individual stocks will be at a quarter, which is a 2.5% position instead of the 10s that we were doing. And a ETF would be a half, which would be a 5% position. And we're not going to do leveraged. We're only going to, so if we do SPY instead of doing UPRO or SSO, we'll do SPY. Until we can get above our 21-day and start trending above our 21-day, we don't want to have death by 1,000 cuts. So we will go in when it makes sense, but we'll go in light until we're making progress. And as we're making progress, you've seen it before. We can ramp up really fast, but now's not the time to be a hero.
Yeah. One other thing I just wanted to mention is, one of the reasons to kind of stay in cash, again, as you said, if we're trying to get 3% max loss, not take hits bigger than that. Days like yesterday, look, we were down more than 5%. And then we were up almost 5%. So you've got almost like a 10% swing that we had yesterday. And that is really tough. And, even today, I mean, we were up, 4% at the open. You try and chase that. And, everything that's kind of happened today. I mean, it was, as you said, we just barely got above the yesterday's high. Otherwise, it would have still been an inside day.
Yeah.
with this kind of volatility. And so that's just not the best type of action to be trying to, as you said, it's really hard to be a hero in that type of environment. So, but it is important because I know we have a lot of subscribers that do watch these. We have a lot of non-subscribers, but for the subscribers in particular, this is where it does require some patience. And it's fine if you're kind of like, oh, you know what, I'm taking a break here. I'm maybe watching a movie, during the trading day or whatever. But even when I was in DC, I was checking in with the market each day, not to trade, but to just be aware, because certainly if there was a change, then I would be wanting to do something differently. When I was doing that at the end of March. So let's take a look at some precedents, shall
Sure.
we?
Yeah,
Because
let's do it.
we did a little bit of, as always, especially like a day like yesterday, we kind of look, okay, this is really unusual. Can we find days that kind of look like this? And so, how far back do you want to start?
At the first date. Yeah.
Okay, so let's go to, we're going to go back to 1978. I was not trading at this time. I was 4 years old. I had gotten reading down, but not trading. So we'll go there, and this is on the NASDAQ. So yeah, walk us through. Here we are below the 200-day moving average line. A little bit, maybe. I mean, this looks even worse in terms of the steepness of how quickly this came down, and relentless. But walk us through what this looks like to you.
Yeah, so let's start at the weekly, just so because people probably don't have 1978 fresh in their memory of what was going on. So this was a big bull market, or a big run in the market there from around 105 up to 140, and then you came down really, really sharply. And what we were looking for were times that looked similar to what we have now. That's what, when you're searching for precedents, that's what you're that's the goal. So this looks in a lot of ways similar. Now, where it's different is the bad breaks happen here above the 200-day, whereas for our current market, it was underneath it. So it's not perfect, but then we were looking for a widespread relative to its ATR. And that's what you have down there. Now, it might not look as bad, just because, one, there's a little bit of a gap in there, so you don't see the whole bar, and the prior bar closed right at the low, or the prior two bars. So this doesn't look as bad as what we saw, but still, it was fitting the definition. And so we were saying, okay, when the market has a setup like this, what should we expect? So let's look out at the next date.
And I should also say that one of the things we were looking at was, we did exclude days that closed at the lows. We
Yeah.
really kind of wanted to see things that closed off the lows, but not necessarily at their highs either. So kind of between 25% and 75% on the closing range of the true range, is kind of what we were looking for to kind of match what we were seeing, right?
Yep, exactly.
Okay, so I'm going to go out a little bit. We're going to go to November 14th.
Okay, so this was to point out why, we were sitting on our hands yesterday and today, is just looking at these like, okay, in the same setup, does it lead to an immediate time where you could be making progress from a swing trading standpoint, or a position trading standpoint? But we were thinking in terms of a swing trade, and no, like, it immediately fails, and it's you're so far away from your moving averages, especially your 21-day, that it needs work in there to get up there. And this one just ended up going lower, so it was the first of the ones historically.
And we'll just go out a little bit further to kind of show how this resolved itself. It did. Again, this is why we're optimistic. It did eventually resolve itself. We got a very nice trending market, back above our 21-day moving average line over here, back above the 50-day moving average line over here, and back above the 200-day moving average line over here. But it did take some time, and it wasn't easy. There were some challenges along the way.
Yeah, and that's another reason why, until we get it back above the 200-day, we are going, after looking at a lot of these, we've decided that we really want to temper how deep in the market and how we're not going to be doing high octane names in any big way until we can get above the 200-day, because even with this, that it ended up working out, that 114.24 day that you pointed to, I mean, that would have been, you couldn't have sat through that from swing trading. You would have had to go to cash on that day, even though it turned back around, and then you have to wait for it to get back above the 21-day. So it doesn't mean like it's easy, but we keep seeing this over and over again with a lot of these examples where we're in this position and then you get a really nice tradable rally. And there was a lot of money to be made there, both from a swing trading and a position trading standpoint, from really from December through, April, there was a lot of trading you could have done. Really good trading.
So I'm going to fast forward to
Sure.
1981. Let me just do it this way.
Sure.
And I didn't realize that you said yes to so many of these, Mike. We might have to go through some of these a little bit faster.
No problem, man.
Let's hit this 1981.
Okay,
This is
so same
825.
basic setup. You're underneath the 200-day. You have a big spread. The day before was a bigger day, so that was a little bit different. But let's jump out and see how it resolved itself. Kind of interesting to have an inside day there, and then you immediately failed again, and that was happening with a lot of these. So that's telling us that, to expect further weakness, a lot further weakness. Now you finally get an upside reversal that is kind of tradable in that position, and you might give it a shot there using the low of that day, but not in a huge way, because your stop is far away from your close. That ends up being the low, and even knowing that, you still wouldn't go in heavy there. You wait for your follow through day that you get, but more importantly, you're trending back above your 21-day. When you roll back through your 21-day, that's when you start backing away.
Great. Let's go ahead and go up to 1990. And we are going to start at the beginning of 1990 with January 24th. And there's a few dates we have here in 1990.
Yeah. So again, similar setup underneath the 200-day, big spread, closing mid-range. Let's see what happens. Again, you go lower, which is why we wanted to point this out. So, just because it stopped and it was capitulation, it doesn't mean it's, that was the bottom.
I'm just going to go out to June now to kind of see how things played out. Here's that January time period. So a lot of back and forth. I mean, yeah, this is a powerful rally here. Absolutely. But it just doesn't last very long.
Yeah, and so I think you guys at home, you should take these dates and really study them, because we don't have time to go over it in great detail today, but look at the windows of time where you're above your 21-day, and that's where we'll be playing it hard. When we get back above the lows above the 21-day, we'll be pressing the gas hard. When we come back through the 21-day, we'll ease off or back out. And then you can see how this then happened again in this huge spread. This one looks a lot more like what we just saw, at least in the near term, accelerating down, and then you get this widespread closing mid-range. Let's see what happens next.
Yeah, so this one, we've got a couple dates to look at. So we can start with 8/17. And again, because there were just a lot of these dates that were very wide spreads. And so here's another one on 8/17.
Yeah, so it just kept going lower.
And then
lower.
A few days later, ugly. And then we can jump out to October.
Yeah.
October 12th. By the way, thank you for putting those extra dates in there for me. Really helps.
We've studied this thing so many times over the decades, together, looking through the NASDAQ, and we just know bad things tend to happen underneath the 200-day, why you lean conservatively. And you can see how much worse it gets, even though at the time it would have felt like capitulation and everyone would be excited. Oh, you got to buy, when there's blood in the streets, you got to buy, and all that nonsense. Okay. So then you finally hit bottom, and look, you get this massive rally. When it does turn and starts trending, it will give you an opportunity to make a ton of money. but you just have to wait for it. You can't force it just because you want to make something. If there's not something there, you can't do it. And look at where does it work when your low is above the 21 day? Just by definition, like that's when you're going to be making the most amount of money, and you can make a fortune in just that small little window.
Mhm. And was this the first Persian Gulf?
I believe so, yeah. I
Yeah,
think
I
so,
I I think so. So,
yeah.
um,
And I think when you went through the 378.03, I think that's when the war started, but
mhm.
I don't know, like, you know, I'm a little tired,
Yeah. So
so I
no,
could be off.
yeah, I'm almost positive this was the first Persian Gulf War.
Yeah. People are
And that
yelling at
was
their screen saying, "Yes," or "No," or, we'll see.
right. Yeah. So, let's take a look at a few others. One I definitely wanted to make sure we hit was this. For those that remember 2011, that summer, wasn't pleasant. We had a lot of back and forth. Just to remind folks, we had already kind of gone through the great financial crisis, but there was a lot of kind of after effects. And so we had a situation where global recession fears were very big in 2011, and we had this fight going on. Greece was potentially going to default on their debt. Germany was saying austerity, austerity. Greece was like, yeah, we don't really like that idea. And there was a lot of uncertainty of whether or not the euro was going to kind of survive or not. Because if Greece defaulted, what would that do to the eurozone, and that whole economy? So here is August 5th, 2011.
Yeah, so similar setup, big spread, and closing mid range. Let's see what happens.
Okay, we'll go just a few days.
And you have such a good memory, man. So again, we ended up going lower, even though now that's a nice looking upside reversal. But again, when there's that much devastation, as soon as things lift, you tend to see this being sold into. So what you're looking for and waiting for are the spreads to tighten up and it to trend above the 21 day. It's really an and statement, not so much an or statement.
Yeah, and then this did eventually resolve itself. I mean, I remember this, very clearly. We had our December 20th follow through day in here, and I wasn't. Well, I'm sorry, it was in here. It was the 17th day. Um, yeah, right there, December 20th. And yeah, I was getting ready for Christmas. I hadn't done my Christmas shopping. That's what I'm thinking about. And then we have this, phenomenal rally. It was short, and it wasn't great for the rest of the year for me. But this rally from December 20th to April 6th, I think, is when it topped. I mean, that was what made the year in 2012.
Yeah, and that was such a tricky time because it was so volatile, and you just focus in on when you were underneath your 200 day the first time until you really got above it this last time. Like that was just what you need to avoid. And I got chopped up in that. Like I did not handle that right from memory. I don't remember what I did exactly, but I just know that whatever I was doing, I was trying to do too much too quickly. And that's again why we're settling down because it's so easy to get chopped up in that. And you go back and you look and there's some powerful days. You got 3 days up, you're around the 22.98, the bottom of it, the
Mhm.
2298.89. I mean, those are three big up days in a row. Like, how can you not get excited about that closing up at the low, at the highs each day? So you are going to trade in that and getting back above your 21 day, but because you're still underneath your 200 day and you haven't trended above it, you really want to temper things. And you can see once your low is above your 200 day for 3 days and you close up, it is a game changer, and those spreads are tightening up.
Yeah, a big difference, I mean, this big move here, you come down, and then it really did. This was so much tighter
Yep.
than what it was before. Now, if we go up to, this was a really tricky period. I mean, we were calling this around the office kind of a mini flash crash here in August of 2015. The way that this just came down so violently, and it was kind of like, why? What? There wasn't really like it just didn't make sense. So yeah. talk about
Yeah,
this
and
one.
that's why there's the quick and the dead, you exit even when it doesn't make sense, and that looked ugly, and that's a warning sign to be careful because the times they are changing. So we can see
Yeah.
the next date.
Sorry, I was looking at some
No
of
worries.
the comments. I told you to go quicker, but I just didn't expect you to listen to me, so my
I'm
fault.
trying, man. We got a lot to go over.
So here we are in September 29th. And look, this took a while to resolve itself. I mean, I remember I started, I was actually working for Scott O'Neill at the time as his assistant, kind of, helping him as he transitioned to leading William O'Neill. And I started writing for the paper here in January, and man, it was just all about like Verizon, Verizon utilities. The first few articles that I was writing on the IBD 50, that's what it was all about.
Did you do like Campbell soups and
Yeah,
and
yeah,
Johnson and
Campbell's. I mean,
Johnson?
basically, it was like dividend plays. I did start out writing some of the stuff for the Income Investor, and it was like, oh wow, there's plenty of setups here.
Oh,
Yeah,
that's
I'll
funny.
just show AT&T at that point. I mean, look at AT&T.
Hey, it was smoking, man.
Yeah.
You gotta trade
Um,
what's out there.
yeah. So yeah, we've kind of gone over a lot of
Yeah, we
the
we
two.
we can move on to the next thing because they're all like that. And so the
Mhm,
point, the takeaway is when you get days like that, like what we've had in the setups we've had, you need to be careful and you need to wait for a few things. You need to wait for a follow through day. That's what happens first. Then a close above your 21 day. That's your next sign that things might be changing. Your low above your 21 day. For me these days, low above your 21 day for 3 days and closing up really kind of changes my mindset on regardless of the moving average. So we need to have that happen on the 21 day, the 50 day, and the 200 day. So a lot of hurdles to get through before it's smooth sailing. And then at that point, once your low is trending above your 21 day for a fair amount of time, like 5-10 days. I mean, you can gun it really hard, and we'll be back on margin at that point. But
mhm.
until we get all those things we're looking for, we're going to either sit on in cash or be very light or both.
Yeah, so here's
Campbell.
October 11th. Again, we've talked about this 2018 as a precedent before.
Yeah.
So and certainly one of the things that we've been warning of, there were a lot of times where we had that pressure to go back in and go back in heavy, because it was like, oh, you're coming off your lows so strong, and then it just immediately, and this is actually good that it immediately started failing, and kind of gave you the sense that, oh yeah, something's wrong here. On this one, you get right up to your 50-day moving average line, you get turned away, and then it was really kind of Christmas Eve that you finally kind of, or Christmas Eve you finally bottomed out and started turning around there. And then, of course, we also have to look at 2020, because
Well,
this
we
was
should just go on that one to just show what happened in like by February or March of how it recovered because it is kind of that theme of, oh yeah, you can see it there. Oh no,
uh,
no,
well,
you
I
can't.
think I went too
Too
far.
far.
So
Yeah.
let's see. Let's go just a few months out.
Yeah. So and that's what we're waiting for. And that's why you're being patient because you're trying to preserve your capital, your physical capital, your dollars, but you're also trying to preserve your mental capital. And if you go in heavy every time you get one of those turns and you get chopped up, when the real turn is there, you're going to be too timid to do it the right way and press because there's a time to press on the gas and press it on hard. And you've seen us do that with Swing Trader and that's my comfort zone, but you've got to do it at the right time in the right way.
And again, as you said, some of this comes from experience. Look, in 2000, I was doing a victory lap because of how great I got out, and I was watching things just get destroyed. I was in cash, and I'm like, just flexing at how awesome I was, and I got ripped apart because every time the market had any semblance of turning around, I think I did okay in the first part, but then at a certain point, I want to trade again. I missed the late 90s, and I was going on margin, very heavy, way too soon when things were way too volatile. And then, by the time the follow through that worked, came around in March of 2003, I was down more than 50% off my high. And I'm like, how did that happen? Like I got out good. I was doing victory laps. How did it happen that I lost that much? And it was because going in too heavy too quickly, as opposed to being able to be patient and say, okay, I've got a lot of chips. I'm way ahead. Let me be a little bit more strategic about when I go in, how quickly I go in, and yeah, patience. I just wasn't patient. So
Yeah, exactly. And the same thing. And we take anyone who's following SwingTrader, we take it very seriously. I take it more seriously than my own account because I know there's people on the other end, and money is important to everyone. And we really want to put on risk when it makes sense, but we also want to protect people as well. And so that's kind of our role, is to,
mhm.
because we've all been in that same story that you talked about.
So now one of the things about this COVID crash, there were, again, this was very, I mean, look, a lot of uncertainty. News was coming out every day that, okay, maybe things aren't going to be so bad. Maybe they're going to be worse than you ever imagined. There were some of the, some of the biggest days of the Nasdaq's history on the upside and some of the biggest days on the downside, and back to back, by the way. So this is where sometimes it's very, you have to be very careful not getting too excited about a strong day, because it can be followed by a day just as bad, if not worse. But here's kind of where things were starting to bottom out. This was on the 18th. Of course, things got a little bit worse on the 23rd, touched a little bit lower than that. But then, by April 6th, we were, we had a fall through day. We were back in the market and things were taking off. And so we started pushing it, and I should say that at the time, we were talking about, hey, it's probably going to be a while before we get back into the market. We're going to be in cash for a while. We have to be very defensive. But then this day happened, and it's like, okay, well, we can start, climbing in a little bit, and it just kind of went from there. And so I'm going to go out to June 5th, and then yeah, I mean,
Oh.
what what are you supposed to do there? Not participate?
Yeah, and again, your low is above your 21 days, so it kind of forces you in. Once, because if you're a trend follower, and if that is your, maybe some people use a 5 day. There's nothing wrong with that, or a 10 day, or whatever your key indicator is, or your key moving average. You got to follow it. And for me, and for SwingTrader, it's the 21 day, and that really forced you. You're trending above it. You've got to find things to trade.
Yeah. Okay, so I am going to stop this share, and I'm going to share something else real quick. Let me switch gears and just kind of go through some of the things that we're looking at in terms of our chips. This graph is showing how invested we are and where we're invested. Yep, it's one big dot, one big circle. It's all 100% cash. But you can see that this is year to date. We typically were using the 50-day rolling period, but it made sense that we kind of look at the year to date to kind of show, look, we had almost a 10% gain. We gave some of that back. We're still 5%. We're still up 5% for the year, whereas the S&P 500 is down more than 15% for the year. So we've got this huge gap of outperformance. I mean, what, we're up 5. This is down, 15. That's about 20. And you can see how even during this choppy period that we had after December 18th and DeepSeek and all of that, we had a lot of these areas where we were getting, much lighter very quickly, and then we ramped up, and then really on February 21st, that's kind of where we went to cash in a big way and pretty much stayed out. Now, there was that follow through day that we were talking about, where we ramped up pretty quickly, but then backed away just as quickly, and have pretty much been out since.
Yeah, and you do a post analysis, or we do a post analysis as often as possible. And I've got to say, even though that follow through didn't work out, given the same information that we had at the time, we would have played it the exact same way, because that was risk reward, it made sense to get in heavy early with a follow through day in that position. Now we're in a different position because we're well underneath the 200 day, and we've had all these failures. So you have to play differently. But for people who take SwingTrader, if I were on the outside taking SwingTrader, what I would be doing, I would focus all my time and energy on how deep in the market are the guys. Is the team 0% in, 150% in, or anything in between? And where is that changing? And so that would be the thing that I would look at more than our stock picks and ETF picks, is how deep. And that's really the main focus. Everything starts there and then goes down from there. How deep in the market are we is our statement. It's not by accident. Now, we could be wrong, and we will be wrong at times, and we have been wrong at times, but we're going to quickly adjust. If we're too heavy, we're going to back away. If we're too light, we're going to adjust that way. But that is the focus, and everything else is secondary.
You know what? Just to that point, I'm going to share real quick, just to remind folks on that are on the product SwingTrader. This is where you can get that. Either on the past trades, current trades. We'll show. Okay, this is as of today. Invested percentage is 0%. A quick little market commentary on what's going on. But yeah, we do put that at top invest percentage, so you can kind of get a sense. And I mean, look, you're going to see that on the current trades. Right now, again, we have zero current trades on right now. But you will remember, as a SwingTrader subscriber, if we do start ramping up, you are going to see that very quickly, because you're going to get those alerts in real time. So that's kind of the benefit of, like, it might seem like, oh, well, wouldn't this be the time to just cancel and come back when things turn? But we can ramp up very quickly. And so I think that we can probably pay for your subscription pretty quickly on that turn. So it's worth it to just kind of keep those alerts at your disposal. Okay, a couple other things that we wanted to share before we go. Let's take a look at just our relative strength, because of course, especially after this past week, the relative strength has been screaming higher. So it's been trending nicely throughout the year, but definitely in a big way. But we also wanted to show that 2020, because again, I think this is what we're looking forward to, because we had gotten out so well. We were out in February in a big way. We really sidestepped a lot of that COVID crash. And you can see that we started ramping up here in April, really, got on margin. By the end of April, we were already back on margin. And this is what really kind of made 2020 one of the best years ever, was because of the way that we had that cushion, to start, and it allowed us to be patient when we needed to and get aggressive when we needed to.
Yeah, so trading is a lot like a poker game, right? And you're deciding what to do based on how many chips you've got in front of you. If you're short stacked, meaning when you're underperforming the market or your bogey or whatever your goal, you have to trade differently. And then when you're even, you trade a certain way, but when you're ahead, that's when you can really press it. And that's something we would both see Bill do when he was doing well, and he had something working. He would really press the gas. Now, he would do it in one stock or two stocks. We do that differently with SwingTrader. We spread it around. But you can see there, I mean, we were close to 200% long there for a little bit, where it made sense, because on there, the purple is SwingTrader and the other things are the moving averages. So we were watching that at like a hawk of our moving averages. So as you're above your 10 and your 21-day moving average of your equity curve, so of your performance, that's when you press it. Those are your chips that you have. And think of it this way for your own trading: the chips are your distance between your moving average on your equity curve. Whether that's, you want to use, let's say it's a position trading account, I'd use a 50-day, a 21-day and a 50-day for swing trading. I'd use maybe a 5, a 10, and a 21. We use a 10 and a 21. There's nothing wrong with using a 5. And when you're going back below it, that's the feedback from the market saying you are doing something wrong, or the market is in a bad position, but you're not handling it right. So back away. So that is what I always think of as my chips, is how many chips do we have? So in that position, you had a lot of chips. That's why we're ramping it. And that's why, like right now, our equity curve is back with those moving averages. So until we would get that distance above them, even though we're doing great for the year and great versus the S&P, you don't want to get sloppy and go, oh, I've got all these chips, I'm up 20% versus the S&P. I don't, I can be aggressive. No. You're at your 10-day moving average of your equity curve. You don't have those chips to spend the way that you think. So because it could turn into a slow death. So that's why we're being so cautious and really protecting. We don't want an unforced error. And I think this could be a really big year for SwingTrader. But we have to do everything exactly right. And that's what we're trying to do.
Mm-hmm. So just to kind of close things out, look, I'm looking at the comments, and YouTube turned into like a whole political debate. And look, my best advice for you is it's fine to have an opinion of what you think is going to happen. I had a pretty strong opinion of what I thought was going to happen with COVID, and I thought it was going to be bad, and if I had stuck with my opinion and not paid attention to the chart, I would have missed out on one of the best years of my trading career. If I had just stuck to the opinion. So at the end of the day, it's fine to have your opinion as long as you aren't ignoring the charts and what the market actually does, because there's a lot of people saying, things could go one way or the other. I'll be honest, I don't know. I can see a path both ways where things go really great, and I could see a path where things go really wrong. At the end of the day, I'm going to look at the market and make my decision off of that, because at the end of the day, I'm trying to make money from this, and I'm not, I'm not so, so married to my opinion one way or the other that I'm willing to lose money, in that regard. So, yeah, I mean, that's where I'm at, folks. I think it's fine to have a political opinion and everything like that, but don't let it interfere with making good decisions in the market. And I think that's why charts and the objectivity that they provide, while there can be a lot of volatility like we're seeing right now, because there's a lot of scenarios in which things can change. At the end of the day, I'm going to rely on my charts personally.
Yeah, and I don't think it's being political at all, thinking through the different outcomes of
Absolutely.
how this could play out, because it's just a reality. It doesn't matter if you're red or blue or purple, with your political thinking. You want to think through strategically, okay, you have this unknown that was out there. Now we have more information because President Trump put it out. We're waiting for more information from other countries of how it goes. And if it de-escalates, we could really ramp up, because people have dialed things back so dramatically because of the other outcome of, let's say, the EU comes back and goes over the top of what China did, and then all these small countries start doing the same thing. It could get really ugly. It could get really bad. That's a possible outcome. I think it's less likely, but that's why we use the 21-day and the follow-through day, because like you said, we have our signals to use. And opinions are worthless. My opinion's worthless. Yours is worthless, and everyone's listening, and everyone in the world. It's just, what is the market going to do? And that's what we're going to pay attention to.
Yeah. So that's going to wrap it up for us this week. Thank you so much for watching. This might be one where you might want to watch again, just for getting those dates if you need them. I think that there is a lot to learn from history. And remember, there was a lot of differing opinions on how things were going to play out in a lot of those different time periods. If you go back historically, for 2011, the global recession, even the Persian Gulf War, the first Persian Gulf War, a lot of different opinions on how things were going to play out. But at the end of the day, the market won out in terms of if you were able to read that properly and react accordingly. So thanks so much for watching, and we will see you on the second Tuesday of next month. Let me see if I can just check that out. What is that going to be? So that should be May 13th. So my sister's birthday. I'll be wishing her a happy birthday on that on that day, and we'll hopefully see you all back here then. Take care, everybody.